In 2020, during the early months of the COVID-19 pandemic, thousands and thousands of small businesses around the world faced a critical problem. Physical stores were closed, customers could not visit in person, and many businesses had no way to accept digital payments. As a result, they started losing revenue. Not because of the lack of demand, but because of the lack of financial infrastructure. So today's topic is about FinTech. FinTech in short means financial technology. It is the use of technology like applications, softwares, and digital platform to improve and automate the financial services. For example, small online sellers in countries like the United States and Europe have tried to move their business online very quickly. However, they have faced major challenges. Some of these challenges include setting up the payment system took 2 days or even weeks. Banks required complex verification processes, and the technical integration was really difficult for non-experts. This created a gap between the business opportunities and the financial capabilities. At this point, FinTech solutions became not just useful but very necessary. One of the most important companies that have addressed this issue is Stripe. Stripe enabled businesses to integrate online payments almost instantly using simple APIs. Instead of depending on traditional banking systems, businesses could directly embed payment solutions into their websites. This allowed thousands of small and medium enterprises to continue operating during lockdown. As a result, digital commerce became more accessible and resilient even in times of global disruption. So from a business and information systems perspective, this case really highlights a key transformation. FinTech is not only improving the financial services, it's also enabling business to continue in a very critical and crisis situations. However, this leads to a deeper question. If financial systems are becoming decentralized and digital, how do we redefine trust and risk?
In traditional banking, millions of people are excluded because they lack a formal credit history. This creates a structural inequality in access to finance. Ant Group addressed this by using alternative data such as transaction behavior and digital activity to evaluate creditworthiness. For example, small business owners who could not get loans from banks were able to receive microloans based on their digital payment history. This is a real shift from institution-based trust to data-driven trust. An even more disruptive real-world case is Bitcoin. Bitcoin emerged after the 2008 global financial crisis, where trust in traditional financial institutions declined significantly. Instead of relying on banks, Bitcoin introduced a system where transactions are verified through blockchain technology. In real-world use, people in countries with unstable financial systems have used Bitcoins to 1. Store value, 2. To transfer money across borders, and 3. To avoid currency restrictions. This demonstrates a fundamental transformation from centralized financial control to decentralized financial system. In conclusion, FinTech is shifting finance in 3 major ways, from intermediaries to platforms, from traditional records to data intelligence, and from centralized control to decentralized systems. So yeah, FinTech isn't just a trend, it's completely reshaping how business and finance systems work. And as future professionals, understanding these shifts really does matter.